ask you something. Have you ever noticed how wealthy people seem to keep buying real estate, paying less in taxes, and somehow qualify for more and more money, while the average entrepreneur is struggling just to get approved? This is not luck. This is not privilege. It's definitely not an accident. It's strategy. Because real estate is not just about cash flow. It's about how banks see you. And once you understand that, everything changes. Most people think real estate is about passive income. And yes, income matters. And banks care about something deeper than that. They care about assets. When a bank sees real estate on your profile, they don't just see property. They see collateral, they see stability, and they see long-term things. Real estate tells the banks that this person understands leverage. This person knows how to manage debt reasonably. This person isn't just chasing money, they're building something. That's why someone with modest income but strong assets can qualify for more funding than someone who makes more money but owns nothing. Banks don't reward hustle, they reward positioning. Now let's talk about one of the biggest real estate loopholes that people hear about but doesn't really understand: depreciation. Depreciation allows you to reduce your taxable income even when your property is making money. So on paper, it looks like you earn less, but in real life, you kept money. That's why you'll hear people say things like, how are real estate investors paying less in taxes? Because the tax code rewards ownership. But here's the part entrepreneurs miss. Depreciation is not about avoiding taxes. It's about timing and strategy. If it's used correctly, it allows you to grow faster while still looking intelligent and compliant on paper. If it's used incorrectly, it can destroy your bankability. And that's the difference between people who own one property and people who build portfolios. Here's what banks actually look at. They look at balance sheet. They want to see assets versus liability, net worth, and risk exposure. Real estate strengthens all of that. One properly structured property can increase your net worth, improve your debt to income ratio, and give banks something tangible to lend against. That's why real estate is often the bridge between small money and the big money. It's not just investment, it's leverage. And leverage, when used correctly, multiplies opportunity. Most entrepreneurs buy emotional. They buy based on hype. They buy based on Instagram. They buy based on what sounds good. Wealthy buyers buy strategically. They ask, how does this impact my taxes? How does this strengthen my bank profile? How does this help me qualify for more capital later? That's the mindset shift. Real estate isn't about looking rich. It's about becoming financially undeniable. If you want to use real estate to reduce taxes, build wealth, and increase your bankability, comment real estate below or click the link in the description. Let's start buying with strategy, not emotions.